timed out on me. Need to take a minute here to log in again. Okay, the two types of problems that are going to be the most prevalent in my lab for this chapter will be petty cash problems and bank reconciliation problems. Those are the only two things that are terribly difficult that you would be expected to do in chapter 7. So we'll go do an example of each one of those two types of problems. This first one is a petty cash problem, and the first part of it deals with internal controls. So here, this data table shows us what the information is on 4 petty cash tickets that are filled out and in our petty cash box. And based on this data, we're supposed to tell, it says select the 3 internal control weaknesses revealed in the given data. And there are 5 different possibilities here that they give us to choose from. So the first one says the sum of the petty cash tickets exceeds the impressed balance, indicating that the petty cash asset has not been properly safeguarded. Well, if you add together these tickets, I don't know what they add up to, but they definitely add up to less than $300, which is the impressed balance of the fund, what they tell us at the top. So that statement to me doesn't make any sense. So I don't think that's one of the weaknesses. Then B says, petty cash ticket number 47 does not indicate which account to debit on the actual ticket. Is that true?
Yeah.
Yes, that's true. So that's apparently a weakness. Okay, then C says the petty cash custodian, KM, did not sign petty cash ticket number 45. Both the fund custodian and the recipient of the cash should sign the petty cash ticket. Is that true?
Yeah.
Yes.
Yes. So check that off. And then D, the fund custodian should not authorize petty cash tickets. Since KM authorized 3 of the 4 petty cash payments, a separation of duties issue exists. Is that true?
No.
No. The custodian's the one who's supposed to authorize the petty cash tickets. There is still a separation of duties, by the way, because at the end of the month, it's the accounting department that reconciles the fund, and it's the treasurer's department that goes to the bank to cash a check to replenish the fund. And then E, petty cash number 46 is missing. There's no indication of what happened to this ticket.
True.
True, yeah. And we didn't talk very much about it, but a control procedure is that you're always supposed to have sequentially numbered documents. So, for example, if your purchase orders are sequentially numbered and one of them's missing, it, suggests that maybe one of your purchasing agents, used the missing purchase order to order a TV for his home or something like that. Okay, so now we're supposed to do the journal entry. So first of all, we're supposed to do establishing the fund. And they tell us it's a $300 fund. So we know when we first establish it, we use that account called petty cash. $300, and the account we credit would be cash when we cash a check at the bank. And at the bottom we put to open the petty cash fund. Okay, then replenishment of the fund on January 31st. Assume ticket 47 was issued for the purchase of office supplies. So we want to have a debit for each thing that we wrote tickets out for. So we'll have a debit for office supplies. We'll have a debit for delivery expense. We'll have a debit for travel expense. So for delivery, for office supplies, there was a $14 ticket, but that one that's not telling us, that's also for office supplies, so that's another $43. So adding those two tickets together, the total for office supplies would be $57. We can put that all in one debit entry. Then delivery expense is $39. And travel expense was $33. Now if I split my screen here for a minute. So we have 57, 39, 33, and the amount of cash that's left in the box is 163. So the total of those numbers is 292. And because it's an impressed system, it should have added up to 300. So if it's only 292, it means we're short $8. So it means that we need to have a debit to that account that is called cash short and over for $8. And then the account we're going to credit is cash. And if the cash we had left in the box is $163, the amount that we have to get from the bank to replenish the fund is going to be $137. And that should make our journal entry balance. And at the bottom we put to replenish the petty cash fund. Okay, then they ask us a couple questions here. The balance in the petty cash account immediately before replenishment is what?
163.
No, that's what a lot of people would probably answer. This is almost a trick question, but it's not 163. Notice they say petty cash account. They don't say petty cash box or fund. If you were to go to the general ledger and look at the T account called petty cash, what would it say?
300.
Yeah, it's 300. We only made one journal entry involving the account called petty cash, which was a debit for 300, so it's 300. And then the other question is the balance in the petty cash account immediately after replenishment is what? 300, yeah. So replenishing the petty cash fund does not affect the balance in the account that's called petty cash. It affects the balance in the account called cash, but not in the account that's called petty cash. Okay, here's our bank reconciliation problem, and this can get kind of tricky trying to move everything around on the screen. So here's the data table that represents our books, or more specifically in this case, the T account for cash. And then the other data table is our bank statement. So we'll first do the bank side of the reconciliation. So the first line on the bank side will say balance February 28th. The figure that we fill in here, a mistake I make sometimes here is that I want to fill in the beginning balance from the bank statement. That's not correct. You want to fill in the ending balance, even though it goes at the beginning of your report. You start with the ending balance, so it would be 3070. And then what you always add on the bank side is, do you remember what you always add? Deposits in transit. And so to know deposits in transit, you have to compare the bank statement to our books. So the last deposit on the bank statement was on February 24th for $1,100. If we look at our books, we see that $1,100 on February 23rd, but then there was another debit February 28th for $2,400. So that on February 28th is apparently another bank deposit that did not reach the bank. So you should always be looking to see if there's something very close to the end of the month that you can't find on the bank statement. So we assume here, see, this is hard moving all this stuff around, but we assume that that $2,400 is a deposit in transit. And then we do a total here. So adding those two lines together gives us $5,470. Then what we always subtract would be outstanding checks. So again, we have to compare the bank statement to our books. And so we have 3 checks that actually cleared the bank. Therefore, 400, 3,100, and 1,100. So it looks like there are 2 more checks there that did not clear the bank, one, for 500 and one for 900. So the way they want us to describe them in this case, other problems in my lab, they may give you a check number and you'll describe it that way, but here we would describe it by saying check issued on February 25th and the dollar amount's 500, and then check issued on February 27th and the dollar amount is 900. So the total for those two checks combined is 1,400. And then we have to subtract the 1,400. Well, we have to put in a label here, I guess. So the label would be adjusted bank balance. And subtracting the 1,400, we're left with a dollar figure of 4070. Okay, now we're going to do the book side. So we start with the adjusted book balance, and from our T account, that's the figure that's labeled as the ending balance, so that would be 4095. And then what we add, where do they give us the additional information here? We just have to look at the bank. On the bank statement, it says EFT collection of note. And there's nothing shown on our T account for the $1,000, so that's apparently something that we would have to make a positive adjustment for. So they call it bank collection of note receivable. That's $1,000. And on the bank statement, there's also interest, $15. Interest revenue earned on bank balance, $15. So the total positive adjustments are 1015. And then totaling these two numbers would be 5110. And then for what we subtract, looking at the bank statement again, there's a service charge for $10. Service charge, $10. There's an EFT payment of rent for $330. And an NSF check, $700. So adding those three negative adjustments together would be 1040. And then the last line is going to say adjusted book balance. And then subtracting the 1040 from the 5110 would leave us with a figure of 4070. And that's the same adjusted balance that we had on the bank side, so that should be correct. That's what I do. Oh, I should have said balance, not adjusted balance up there at the top. Okay. Then we're supposed to do the journal entries, and they help us out here by telling us what journal entries to do, but if they didn't tell us this, remember the rule is that you have to do a journal entry for every adjustment that was on the book side, but not the bank side. But here they say begin with the EFT collection of the note. So anything that's a positive adjustment, we know that we're going to debit cash for it to show that cash was taken in. And so that one was for $1,000. And the account that we would credit would be notes receivable. And at the bottom we put note receivable collected by bank. And then next, journalize the interest earned on the company's cash balance. So again, we will debit cash, we will credit interest revenue. This is for $15. The bottom we put interest earned on bank balance. Then journalize the service charge. So now we're going to want to debit an expense account, and so apparently the one we should use for this will be bank expense, $10, and then the credit will be to cash. And we'll put bank service charge. And then the NSF check. Does somebody know what account we would want to debit for this?
What was the question again? The main question.
Okay, we're journalizing an NSF check. So these choices they give us, which account would we want to debit for it?
Would it be notes receivable?
Yeah, good. So back when we thought the customer had paid us off, we credited accounts receivable to remove that customer's receivable from our books. But it turns out the customer really didn't pay us because his check bounced. So we have to reestablish the account receivable, something we'll talk about more in chapter 8, to show that the customer really does owe us money. So that's why we're debiting accounts receivable to put it back on our books. And this was for $700. And then we will credit cash, $700. And at the bottom, NSF check returned by bank. And then EFT payment to Easy Rent. So the debit will be rent expense for $330. The credit will be cash. And we'll put monthly rent expense. Okay, then I have just a few multiple choice questions. A couple of these are things we didn't really cover in the lecture, so I just wanted to make sure that you're familiar with them. Maybe you can figure these out anyway. Which of the following statements regarding a